Welcome to another podcast of the Riffle series. The Riffle, a podcast series brought to you by 10 Leaves. Today, you and I are diving into something pretty high stakes.
Yeah.
The UAE's really stringent legal framework for tackling global financial crime. This isn't just, ticking boxes. It feels like it's about the UAE really cementing its place as a transparent global financial hub. We're looking at this stack of laws, federal decree laws, cabinet decisions from 2018 right up to 2025,
Yeah.
specifically targeting money laundering, terrorist financing, and proliferation financing.
That's exactly it. And it's not just theory. This is intensely practical. It's basically an operational manual for anyone caught in its net. What we want to do here is cut through all that dense legal text, give you the essential mechanics. So who has to comply? What exactly do they have to do? Some of these duties are surprisingly detailed. And crucially, what happens if they slip up? The consequences are significant. This framework demands a pretty complete operational shift for businesses here.
Okay, let's start by unpacking the actual crimes. These aren't vague concepts. The law is very specific, which has real implications for how they're prosecuted. Money laundering, ML first.
Yes, and what's really interesting here, legally speaking, is that the UAE framework treats money laundering as an independent crime. What that means, basically, is if you hide dirty money, maybe transfer it, try to conceal where it came from, even just acquire it, you're guilty of ML. And this holds true even if the person who committed the original crime, the predicate offense, is never caught or convicted for that initial act.
Wow, okay, so the authorities don't need to nail the original fraudster or trafficker. They just need to prove the money was bad and you helped hide it. That sounds like a powerful tool for them.
It really is. The prosecution just needs to infer the illicit source, maybe from the circumstances, the type of transaction. Maybe it just makes no economic sense. They don't need proof you knew about the specific original crime. It definitely lowers the bar for proving the ML charge itself.
And the other two big targets, financing of terrorism, FT, and proliferation financing, PF. Distinct concerns, obviously.
Absolutely distinct.
Yeah.
FT is, providing funds could be clean money or dirty money, but knowing they'll be used by terrorists or for a terrorist act. PF is maybe a bit newer in terms of focus, and it's very specific. It's about providing or collecting funds knowing they're for weapons of mass destruction, WMDs. Production, development, transfer, things covered by UN Security Council resolutions. It shows the UAE is actively plugging into global security efforts through its financial system.
Okay, we have the what. Now, the who. Who actually has to follow these rules? It's not just banks, is it? You mentioned designated non-financial businesses and professions, DNFBPs.
Right, and this is where the net gets much wider. It catches businesses and professionals who maybe wouldn't traditionally see themselves as being on the front line of financial crime compliance. The DNFBP list has three main groups, and the triggers for compliance are quite specific.
Okay, give us those triggers, like what ropes in a real estate agent, for example.
So real estate brokers and agents are included, yes, but it's specifically when they're closing deals, purchase or sale of property for a client. Then there are dealers in precious metals and stones, again, specific trigger. Only when they're involved in a transaction that hits or goes over AED 55,000.
55,000 dirhams.
That's a very precise number. Is there a logic behind that specific amount? Does it tie into international norms, maybe?
It generally does align with international efforts to capture transactions that are significant but often cash-heavy. Think high-value luxury goods, right? Specific jewelry items, expensive watches, making sure those don't become easy ways to wash money. For a smaller dealer, though, documenting every transaction over that amount, that's a definite increase in administrative work compared to how things might have been before.
And the third DNFBP group, often the one where client confidentiality gets tricky, lawyers and accountants. That's right. Independent legal professionals. So lawyers, notaries, and independent accountants. They fall under the rules when they're actually doing financial transactions for clients, things like managing client money or accounts, setting up companies, or, managing those legal structures. It's tied to their transactional role, specifically, not just giving advice.
And we absolutely have to mention virtual asset service providers, VASPs. They were specifically added in the more recent updates, weren't they?
Yes, exactly. Including VASP shows the framework isn't stuck in the past. It's adapting to crypto, digital finance, making sure compliance covers all types of asset transfers. It makes the whole system incredibly comprehensive.
Okay, scope is clear. Financial institutions, key DNFBPs, and VASPs. Let's pivot to the core mechanism. Finding out who your client really is. Customer due diligence, CDD. When does that kick in?
CDD is fundamental. It's about identifying and crucially verifying the customer, and also the ultimate beneficial owner, the BO. You also need to understand what they do, their business activity, and why they need this relationship or transaction. And the timing is key.
Yeah.
It has to be done before or during setting up the relationship. Or if it's a one-off transaction for someone who isn't a regular customer, before you execute that transaction.
That verification step, though, it can sometimes slow things down, can it? Getting a new, legitimate business relationship off the ground. Is there any flexibility or is it strictly upfront?
There's a little bit of wiggle room, but it's tightly controlled and risk-based. If you've identified a case as genuinely low risk, you can complete the identity verification after the relationship has technically begun. But, and this is important, you have to document why it's low risk, you have to get the verification done promptly, and you need strong risk controls in place during that interim period. It's definitely not a free pass.
Right. That brings us neatly to the beneficial owner, the BO. Corporate structures can be like Russian dolls sometimes. How does the law define who ultimately owns or controls an entity?
So the BO is defined as the natural person, the actual human being, who ultimately owns or controls 25% or more of the company's shares or voting rights. That control could be direct or could be through a chain of other companies. The 25% threshold is pretty standard internationally. It's meant to capture significant influence.
But what if you do all the checks, you dig deep, and honestly, no single person hits that 25% mark? It happens.
The law anticipates that. If, after exhausting reasonable measures, you can't identify a natural person at the 25% level, then the BO is deemed to be whoever holds the position of higher management official. Basically, someone senior has to be formally responsible. And practically speaking, companies themselves have a duty here. Legal persons must maintain a register of beneficial owners, and they have to update it fast within 15 business days if they become aware of any change.
15 business days. That sounds tight, especially for complex ownership structures that might span borders. What kind of proof do they need that they updated it on time? That must demand really good internal tracking.
Oh, absolutely. It demands robust internal systems. If you fail to keep that register accurate or miss that 15-day update window, you're looking at administrative penalties straight away because, it undermines the whole transparency goal.
Okay, all this ties back to the risk-based approach to the RBA. So if a business identifies something as high risk, what extra steps do they pestilently have to take? This is enhanced CDD, right?
Exactly. Enhanced due diligence, or EDD. And this is where the compliance effort really ramps up. For any high-risk customer, you must get senior management approval just to even start the relationship. You have to dig deeper, ask for detailed info on the source of their funds and the source of the beneficial owner's wealth. It's not just about the transaction money. And it's not just upfront checks. Ongoing monitoring needs to be significantly enhanced.
What does that actually mean in practice, though? Significantly increasing the frequency and intensity of ongoing transaction monitoring for the compliance team on the ground.
Well, it means you can't just rely on automated alerts. It probably means more frequent manual reviews of the whole client relationship, maybe monthly, maybe quarterly. It means relationship managers might need to provide written justifications for large or unusual transactions. You're basically building a close business relationship while at the same time being legally required to scrutinize and document their every move much more closely. It's a difficult balance.
Definitely sounds like it. Okay, now let's get into some really specific targeted requirements. Wire transfers seem to have incredibly strict rules, especially about the originator data.
They really do. The aim here is clearly to strip anonymity away from money movements. For any international wire transfer that's AED 3,500 or more, the financial institution sending it must ensure it includes specific originator details. We're talking full name, their ID number or travel document details, address, account number, and the same level of detail for the beneficiary receiving the funds.
AED 3,500, that's what, under $1,000 US? That feels like a remarkably low threshold for needing all that ID documentation on international transfers. Does that have a big impact on things like everyday remittances or small cross-border business payments?
It certainly means that almost all standard consumer remittances and even many routine business payments now have to be fully traceable end-to-end. The law does note that even for transfers under AED 3,500, you still need the basic name and account number. But the key is the system ensures the information is captured. So if suspicion ever arises later, the trail is there to be followed.
Okay, let's touch on a major red flag area. Shell banks. What's the rule there? Is it just don't deal with them?
It's an absolute prohibition. Financial institutions are forbidden completely from setting up or even maintaining correspondent banking relationships with shell banks. And a shell bank is defined clearly. A bank with no physical presence, that isn't part of a regulated financial group, it's a non-negotiable line in the sand. Cut off the dodgy channels.
But wait, the ban goes further, doesn't it? It's not just dealing directly with a shell bank. It's also dealing with any other bank that allows shell banks to use its accounts. How far does a bank here have to investigate its big overseas correspondent partner to be sure they aren't letting shell banks slip through their own systems?
The due diligence burden is significant. You have to do enough checking on your correspondent partners to be reasonably sure they aren't enabling shell banks. And given the penalty for getting this wrong, the administrative fine is AED 1,000 just for the shell bank violation? Well, that focuses the mind. Financial institutions have a massive incentive to be extremely thorough here.
Right, makes sense. Okay, last one in this section. Politically exposed persons, PPPs. Can you quickly define who falls into that category and how the rules treat foreign versus domestic PPs differently?
Sure, PPPs are people like heads of state, senior politicians, top military brass, senior judges, executives at state-owned enterprises, plus their immediate family members and known close associates. The key difference in the rules is based on geography and perceived risk. For foreign PPs, enhanced measures like getting senior management sign-off, checking source of funds, extra monitoring, these are always mandatory. The inherent risk is considered higher.
Always for foreign PPs. Okay, and for domestic PPs, people within the UAE's own structures.
For domestic PPs, those enhanced CDD steps are only mandatory if the specific business relationship itself is assessed as being high risk. It's a slightly more pragmatic approach, perhaps acknowledging that a domestic official operating under local oversight might present a different risk profile than a foreign official potentially involved in corruption elsewhere.
Got it. Okay, now we're really getting to the sharp end. Reporting and enforcement. If a compliance officer spots something suspicious and files a suspicious transaction report in STR, what's their absolute top duty, especially regarding client confidentiality?
The duty is crystal clear, and it's immediate. Financial institutions, DNFBPs, VASPs, they must report STRs straight to the Financial Intelligence Unit, the FIU, directly and crucially without delay. Doesn't matter how small the amount is. And here's the kicker. They have to do this without invoking bank secrecy or professional secrecy. The public duty to fight financial crime overrides traditional confidentiality obligations completely.
Wow. That override of secrecy must create enormous tension in the client relationship. And if someone breaks that silence, if they warn the client an STR has been filed, that's tipping off, right? What's the penalty for that?
Tipping off is treated very seriously. Revealing that an STR has been filed or even hinting that an investigation might be underway is a criminal offense. You're looking at potential imprisonment. The law says no less than 3 months and a hefty fine, at least AED 50,000. The system criminalizes anything that could disrupt an investigation. It forces cooperation.
And the penalties for just general noncompliance, even without tipping off? They seem designed to be genuinely painful, not just a cost of doing business. Let's talk administrative fines.
They are definitely designed to deter. Supervisory authorities have the power to levy fines from AED 10,000 up to a really eye-watering AED 5,000, and that's potentially per violation. And the specific fines signal what the authorities view as particularly bad failures. We mentioned the Shell Bank one already, that's AED and 1,000. Another example, failing to report an STR where you also failed to do proper CDD. That can trigger a fine of AED 200,000. They connect the failures.
And it's not just about money, is it? What other sanctions can regulators impose?
No, it goes beyond fines. Sanctions can include things like banning individuals from working in the sector entirely. They can restrict the powers of the company's management, suspend the business's activities, or in the most severe cases, actually cancel their operating license. The goal is to force compliance to be the absolute top priority.
We should also quickly cover targeted financial sanctions, TFS. These relate to specific terrorist and proliferation lists. How fast do businesses need to act on those?
Compliance with TFS lists, both from the UN Security Council and local UAE cabinet resolutions, is mandatory, and the key word here is immediate. If someone on a list has funds with you, those funds must be frozen instantly. And critically, without prior notification to the listed person, speed is essential to stop assets moving.
And finally, this commitment to working with other countries seems baked right into the law, even overriding some traditional reasons for refusing cooperation.
Absolutely. The UAE law mandates that international cooperation requests on financial crime get priority handling. And it specifically says requests cannot be turned down just because the underlying crime involves tax or financial matters or because it's deemed political. That really underlines the UAE's commitment to being a serious global partner in fighting this stuff.
It's just a phenomenal level of detail we've gone through, from nailing down definitions for virtual assets and proliferation financing to setting those very specific cash thresholds for jewelers, and then the complete operational shift required for compliance teams facing these huge potential penalties, both administrative and criminal.
Yeah, and the absolute key takeaway, I think, is how this whole framework systematically pushes the burden, the responsibility for identifying people, monitoring them, reporting suspicious activity, managing risk squarely onto the shoulders of the FIs, the NFBPs, and VASPs. It's that combination. Comprehensive definitions, quite low monetary triggers in places, and then really severe escalating penalties for failure. It all signals a very strong determination to meet and maybe even exceed global standards for financial integrity.
So here's something to think about, perhaps. When you consider those really detailed data requirements for even relatively small international wire transfers, and then you add the criminal penalties, including potential jail time for tipping off a client, how fundamentally does this change that traditional relationship? The one supposedly built on trust and financial confidentiality between a business and its client. It seems like you're now legally obligated to act almost as an extension of state enforcement, even if doing so potentially destroys that client relationship you worked to build. That must be the tension every compliance officer is wrestling with right now.